All right. So hey, what's going on? My sound. Oh, that's good. Okay. All right, let's get started here. So yeah, let's talk about stock versus the real estate. So have you ever wondered like which investment would be better over the long run? So how rich would you be if you knew that in 1990 Apple would go IPO and it would be one of the most successful company in the stock market? How do you feel about that? Right? We're just discussing there was also a lot of articles written about that. And you wish you had a crystal ball, right, in those at that moment. And you wish you would be able to send yourself maybe a message saying, hey, invest in Apple. This is one of the best stocks that is ever going to be on the stock market. So, but how does that help me today, right? You look at the stock market today and which stock do you pick? Which stock is going to be the Apple of the future? Is it Nvidia? Is it OpenAI? Is it X? Is it Tesla? There's a lot of very strong companies out there. But which one would you bet on for the next 20, 30 years? If you had to pick one of these companies, which one would you pick to be the Apple of the future? And that's what the discussion is about here. And how would you compare the two? And this is what I had been thinking about is how would I compare these two things, these two types of investment? I could just go and do one, kind of like just show numbers and say, yeah, this Apple is better or the stock market is better. And then you have a bunch of people that would say no, a bunch of people that would say yes, and it just doesn't make, nobody would believe me. So that's why I have to kind of go with, I have to go through an example. I have to figure out a way that is going to be believable and that everybody's going to look at this and say, yeah, I guess that makes sense. That's how I came up with these numbers. And this is why I came up with two investors, and I call it the tale of two investors. We're going to go, everybody loves a good story, and this is what we're going to do here. We're going to create a good story about two investors. One of them is going to be Mr. McIntosh, who is going to invest in Apple. Get it? And you can see Mr. McIntosh has a little crystal ball here, and that's because he has this crystal ball that told him Apple is the stock to invest in, the company to invest in. On the other hand, we have Mr. Moore, ordinary real estate investor, and he's just going to do his best, poor person. But this is kind of like how we would do. I mean, these two guys are friends, and they're going to start with the same amount of money, and then they're going to see how they fare over time. The goal is for the stock market for Mr. McIntosh to invest in the best company on the stock market and then see how it goes. And then for Mr. Moore to invest in real estate rental and see how he fares over the long period of time. So that's the goal. And then in order to achieve this goal and to demonstrate this comparison, I had to collect a bunch of data. I have to collect historical data on Apple, including dividends, the stock split, whenever they did the stock split, collect housing data, historical mortgage rates, because these mortgage rates obviously are used when Mr. Moore is buying some rental properties. He's going to use mortgage to do that. Then we're going to have inflation data that's going to be used to increase the operating expenses. Is going to be used also to increase the rent on the rental unit that Mr. Moore has. And then with all that information, so I had to create obviously a model that's going to calculate the investment for each of the investors. Of course, you have to have some rules, right? Because otherwise it's just going to be a free-for-all. And here are the rules. So both of them are going to aim to maximize equity and wealth. They're going to reinvest cash. Mr. Moore is going to get net cash flow, that's NCF here. So net cash flow from the rental. So he's going to reinvest that. Mr. McIntosh is going to reinvest the dividends that he's getting from Apple. So nobody is going to be able to sell their assets and then to kind of rebuy them. So there's no transaction. It's just a pure accumulation. So McIntosh doesn't have that kind of crystal ball that's going to say, hey, you had the peak here, now sell it and then buy it at the bottom. And Mr. Moore doesn't have any crystal ball, so he doesn't know. But he's also not allowed to sell his assets in order to kind of like capitalize on that. If you think of the Great Financial Crisis, for example, he's not allowed to go in there and then sell at the top and then buy everything back at the bottom and save a whole bunch of money. You can add capital. So they start with the same amount of money, and it's basically everyone is in their closed box, and then and basically nobody can add capital. Also, if they keep cash, the cash is at zero interest. So they're not making money. If they hold a bunch of cash, they're not making money in cash. So it's 0% interest on that. And as we said, Mr. McIntosh has a crystal ball, Mr. Moore doesn't. And then they both start with a capital of $4,400. That will afford Mr. Moore to buy his first rental property. And of course, McIntosh can just go and buy his first few stocks with that at that point. Okay? So let me take you back in time to 1980. So this is the beginning, December 12th, 1980. That's when Apple stock hits the market, the IPO. And the share price at that point was $22 per share, and McIntosh buys 200 shares, totaling $4,400. Now, Moore used that money to buy a $17,000 single-family rental. So again, I captured a whole lot of the data around historical data around real estate in the same areas that I invest currently and all of that, and the same kind of like single family rental that I'm investing today. So that's what we're doing. Notice that the mortgage rate in 1980 was 13.74%. Okay, so a lot of people are telling me, say, oh my God, this is like this 7% interest. This is incredible. This is it's so expensive. But Mr. Moore is starting at 13.7. The first house I bought was actually at 18% interest. So anyway, rent $2,500 a month, net cash flow basically break even at $10 a month. So this is what we're seeing here at the very beginning. So we're going to have a bunch of tables like that throughout this presentation that's going to show kind of like the difference between the difference between McIntosh and Moore in terms of their assets, in terms of their liabilities, and what we're focused on here is the net equity. I mean, you already see the difference here is that Moore has $17,000 in asset value, but he has a mortgage on that, and then that comes up to the same net equity. And this is really where we're going to make our comparison. Now, I want to make this a fun story. I'm not going to show you a list of tables one after the other. I really want you to get the feel and kind of go back in time about kind of what was going on, what was the vibe in those years. So that's why I'm going to go back now to fast forward to 1985. And then that's Ms. McIntosh was absolutely very concerned to read that Steve Jobs was kicked out of Apple. I mean, he was the genius behind it. He was the designer. He was the vision. Like, nobody ever imagined that Apple would be separate from Steve Jobs. This is like nobody ever thought that. Anyway, so Steve Jobs was kicked out, and then he started a new company called Next, and that company will just compete directly with Apple. So, and everybody's asking, like, what's going to happen with Apple, without its co-founder? How's that going to affect the stock price? Is the Next, this new company that's going to start, is that going to be a big threat? I mean, Steve Jobs knows all the issues with Apple, and now he's going to create a new computer where it's going to be, he's not going to create the same mistakes or the same issues. I don't know. He knows all the problems with Apple, so he's a very good position to compete with Apple and basically destroy Apple. And this is what everybody's thinking in 1985, is that, oh my God, if someone is going to do damage to Apple, it's going to be Steve Jobs with the new company. 1987, so Apple starts paying dividends, 12 cents dividends, and they announce a stock split as well of 2-for-1. And then at that point, Mr. Moore has enough money, not that much money, but he has enough money to buy one extra share with dividends that he receives. So he buys, so now he has he had 200 shares at the beginning, now the stock split was 2-for-1, so he has 400, and he's able to buy one more share. So he ends up with 401 shares, and his asset value has increased to $16,000. That was from $4,400, remember. So that's not bad. Well, 7 years, 4 times the value. I think a lot of people would be happy with that. 4 times the value. That's a 20% return, annual returns on that. Everybody's happy with that. If people invested in S&P 500 or NASDAQ, they wouldn't get 20%. They would get 9-10% on their annual returns. Mr. Moore still has one rental unit, some asset here, $23,000, so this appreciated over time. He's accumulated some cash. This is cash he has accumulated from the net cash flow, from the rental, right? And then he has liabilities, so you can see that his principal has gone down from the amount of money that he owed, and the net equity is $15,000. So annualized rate of return 19%, a little bit less. Net equity a little bit less than Mr. McIntosh. So it's pretty even, though. I mean, I don't think it's a big difference. But will that continue in the future? Now, Moore decides that he wants to refinance. So he has a little bit of money, but he doesn't have enough to buy another property. So he refinances. He owned these properties for for 7 years. So it has built some equity, and then now he wants to leverage that, and he wants to get a mortgage on that, and then get a refinance, and then he would be able to extract some money here, increasing the mortgage here, and then that would add some cash that he would be then able to invest and buy 2 more properties. So after the acquisition, he would have 3 properties, and the asset values would be about $72,000. He would have less cash, obviously, but you can see that the net equity would be the same. It's just like a balance sheet exercise. This moves here, this moves there, and then but the net equity would basically be the same. So now he has 3 properties, and that's going to affect really his cash flow a little bit. So instead of making he was not making that much in net cash flow, but now after this refi and acquisition, now he's getting this amount of rent, and the net cash flow is $645 a year. Okay, so not that much. So that's kind of where we are here. Then we have 1988. Now Apple forced out of Steve Jobs was forced of Apple, as you remember. Now, he finally next is launching their first computer. 1988, they launched what's called the Cube, and it was not really seen as a big surprise, big launch. It was not a big success. That's the word I'm looking for. It was really going not so much after Apple, but more after kind of like the big box computer that were there at the time, like the Dell, the Gateway. I don't know if you remember those, but so it didn't look like an Apple. It was not really that great, and it didn't look that good. The aesthetic was not what you would expect from an Apple-like product. So not exactly what we expected from Steve Jobs. Not so good. On the Apple side, on the other hand, from 1988 to 2000, so Apple faces a whole bunch of problems. It nears bankruptcy because they had launched all kinds of different products that basically didn't work. Like Newton was one of them. That was kind of like their first tablet. Then they had like a camera. They had a game console. I don't even remember that. And then Apple was bailed out by Microsoft, out of all people, the big competitor, because at the time Microsoft was fighting monopoly. So he was in front of the federal court, and they were about to basically be forced to split, or do something. So they were kind of like against. There's a law against what's that word? Monopoly. So they were afraid that they were kind of monopolizing the market. They were also forcing computer companies to install Windows by default on all the computers. So when you bought a computer, you were buying Windows whether you liked it or not. You had no choice. It was part of the price. Yes, you could uninstall it and all of that kind of stuff, but you bought it already. So anyway, so that was the issue there. Lots of product failure. And then in 1995, they actually stopped paying dividends. Okay, so one thing that's interesting here that I want to, a lot of when we are comparing, if we just set aside the money for a moment, when you're comparing stock market investing and investing in real estate, a lot of it comes down to control. So some of the control that you have when you're running your own real estate company and your investment, you have a lot of control. You have a lot of decisions that you can make. When you're investing in a company that's on the stock market, you don't have the control. You don't make the decision. Mr. McIntosh didn't decide to fire Steve Jobs. He would have never decided to do that. So these decisions are not his. So when you buy in the stock market, a stock on the stock market, you don't have control. You're assuming that these people have all the control and they know everything. So same thing here with stop paying dividends. So this is not good for Mr. McIntosh because he needs the dividend, right? Imagine if you relied on a stock or a company to provide dividends for you to retire on, and all of a sudden they decide, hey, I can't pay dividends anymore. I'm growing something. I'm building a data center for my AI, and I need all the cash that I need. So I'm going to stop paying dividends. So what do you do then, right? I mean, I don't want you to invest in a data center for AI. I don't want you to spend $2 billion in NVIDIA chips, etc., and then another $6 billion on a data center. I don't want you to do that. I want you to stay focused on whatever you were doing before. Anyway, so that's kind of like my thought here, is that you don't control the decisions that are being made by these people. So, off of that. But then, surprise, December 1996, Apple announces the merger with Next. So Apple then retains Mr. Jobs as an advisor first, and then in 1997 they kind of make him interim CEO, and eventually he became CEO again. But that took a little while. Now, let's go to June 2000. So, with all the stuff that was going on, McIntosh really trusts the crystal ball and continues to reinvest his dividend. So in June 2000, they have a stock split, 2-for-1. The share price is $55.62 at that point. And then, so this is where he is at June 2000. He owns 874 shares. The total asset value is $48,000. And that's a return of 12%. Still very good considering all the problems, all the turmoil, the bailout, and everything that had happened since then, right? So I think this is pretty admirable that they got there. On the other side, on the other hand, Mr. Moore has some cash flow. Cash flow is coming in, And he was able to really to add maybe like one property every other year, roughly, when he had enough cash. So by June 2000, Mr. Moore now owns 14 rental units. So the asset value of the rental units $556. The cash, he still has cash on hands, and then he has this net equity, that's the asset plus cash minus liability, is $265,000. Well, this is a lot better than Mr. McIntosh, isn't it? This is a big difference here. 14 units, then also on the cash flow, right? So the rent, expenses, net operating income, pays the mortgage, and then the net cash flow is $15,000 a year. So he's making about $1,000 a month from his rental property, net, after all the expenses are paid. So Mr. Moore is doing pretty good. And this is pretty passive here. He has a property management company. This is all part of the operating expenses, so he doesn't have to worry about all that kind of stuff. Now, compared to two, this is where we are. McIntosh, 12% returns. Moore, 22% return over that period at December 2000. Okay? So that's kind of where we are. Now, do you remember 2000? Do you remember what happened? Right? So in December 2000, everything was fine and dandy, but then in 2001, kind of like 2000, 2001, this is when the dot-com bubble really burst, exploded. Apple stock went from $55 to $14 in a very short period of time, as you can see. So obviously, McIntosh is not doing too well in terms of asset. So he went from $48,000 in asset value to $12,000 after the crash. Of course, he's a long-term investor, so he doesn't really care too much about that, but it still cares a little bit, right? So he looks at that and says, if McIntosh was relying on this to retire because he was doing like an asset withdrawal method or something like that, it would be painful. He would have to go back to work or something like that. So I don't know what decision he would have to make, but it would be pretty painful. So that's kind of where we are here. That's what's happened to the dot-com crash. Most of the stocks, Apple did pretty good, but a lot of the stock market went down 76%. I was caught in the dot-com crash also. I had tons of stock options. I also had diversified, like literally in November, December of 2000. I had diversified. I had a money manager that was managing a portfolio of stock for me. I had over like 100 stocks. It was all diversified. It was all diversified in the stock market, but that's not diversification. This is one of the points I want to make too with this presentation, is that you want to diversify into different asset classes. And this is going to highlight this, because you're going to see what's happening with Mr. Moore at the same time that the stock market collapse, the dot-com crash happened. But really what you really should really think about is that, what if you had both? What if you were both Mr. McIntosh and Mr. Moore? If you had a little bit, maybe 25% McIntosh, 75% Moore. The stock market would have gone down, but that would have affected 25% of your net worth, as opposed to here what's happening with McIntosh, 100% of his net worth is affected by the dot-com crash. So anyway, I was completely burnt by this dot-com crash. I lost millions of dollars in the dot-com crash. And that's why I'm recommending this, is I keep talking to people about making sure that they diversify into different asset classes. This is something that's very, very important. Okay? So that's kind of where we are now. So Mr. Moore, on the same period, decides that he wants to refinance his property. So he had 14 rental units. Asset value is there, and then he has some equity. Now he wants to refinance. After the refinance of these properties, he ends up with $154,000 in cash, Obviously, the mortgages are bigger because he refinanced, but the equity is the same. Net equity is the same. Kind of like moving equity from the asset up to the cash, and then use that cash to buy more rental properties. So 17 rental properties extra. There's a little bit of cash left, and now, same net equity, but you can see that the asset value has significantly increased. Okay, so that's where we are. In terms of cash flow, the cash flow here is slightly increasing, just because the mortgage has increased so much that is basically the cash flow is pretty similar. Now, 2000 to 2005 is a big period. This is where Apple is really coming back with great products that are very successful. The iMac, the iPod, the iPhone. They open retail stores. They open the iTunes stores. And they do a stock split in 2005, 2-for-1. So things are going very, very well. And, and Macintosh is absolutely ecstatic. Real estate side, same period, 2000, 2005, it's a real estate bubble. So this housing boom, the prices are going up, and he continues to acquire properties because he has a lot of cash flow that he has to invest, right? So he has two choices. He can leave the cash there and make zero return, right? Or he can invest it in real estate and at least appreciate, have the real estate appreciate over time. In 2005, he refinances his properties to acquire more properties. And this is what it looks like at the end of 2005 after the acquisitions. So Macintosh there's a stock split, remember, so 1748 shares, the asset value $78,000, and then the annualized rate of return 12%. Now you gotta think, well, this is very low. Well, this is still better than if someone had invested in NASDAQ or S&P 500 over the same period of time. This is a better return. Okay? Remember, Macintosh has a crystal ball. He knows that the Apple stock is absolutely phenomenal and is going to continue to grow very rapidly. Mr. Moore has acquired even more properties here, so now he's at 50 units, and his net equity is $1.3 million, and his annualized rate of return is 25%. So that's pretty amazing, and that's due to the boom in the real estate and the value of real estate over time. His cash flow also has increased now to $44,000 a year. So that's pretty significant. All right, so if you like this presentation, make sure you leave a comment. I will try to do section 2 or part 2 of this video. In the meantime, check out Investor Game Plan if you're looking for ideas on how to get started in real estate, where you can download my Investor Game Plan Starter Kit. You can also book a call with me, and I can look at your particular situation, your job, your any kind of real estate you have or investment, and we can talk from investor to investor about what is the best way to allocate your investment so that you can protect yourself and grow. After this is not the end of the story. After this, I'm going to talk about the great financial crisis of 2008 and how it affected Mr. Moore and how it affected Mr. Macintosh. So make sure you comment, make sure you like this video, subscribe to the channel so that you are notified when I'm going live next. And that's it. Enjoy, have a happy Thanksgiving if you celebrate that. And if you don't celebrate that, then enjoy your holidays or vacation and whatever is going to happen the rest of the year. Talk to you later. Bye.